studying your last two. I swim with tea when they turned in. The staring down to mute and can learn the pole that sunk he died.
For many years, income sprinkling was one of the most common tax planning strategies used by incorporated business owners. The basic idea was straightforward. Instead of having all corporate income taxed in the hands of one individual, income could often be distributed among family members through dividends. By spreading income across multiple family members, the overall family tax bill could often be reduced. As shown on the left side of the slide, this approach was widely used. A business owner could pay dividends to a spouse, adult children, or other family members who own shares in the corporation. Because those family members might be in lower tax brackets, the family as a whole could often save tax. For many years, this was a common planning strategy in private corporations. However, the planning environment changed significantly. At the center of the slide, we see Parliament and a new set of tax rules being introduced. This represents one of the most important shifts in private corporation tax planning in recent years. The Liberal government introduced new income sprinkling rules designed to limit situations where family members received income without sufficient involvement in the business. The government's objective was to restrict what it viewed as inappropriate income splitting arrangements. As a result, the planning landscape changed. The calendar shown in the center captures this transition perfectly. There was a before period and an after period. What worked in the past could no longer be automatically assumed to work in the future. On the right side of the slide, we see the new reality. Income sprinkling did not disappear entirely, but it became much more regulated. Advisors could no longer simply look at a shareholder list and assume dividends could be paid to everyone. Instead, additional review became necessary. Qualification matters, eligibility matters, documentation matters, and professional analysis became much more important. Notice the blocked dividend arrows shown in the illustration. This visual represents the fact that some family members may qualify under the new rules, while others may not. The answer depends on the specific facts and circumstances of each situation. The warning message in the center summarizes the entire change. Income sprinkling is no longer automatic. Qualification matters. This statement represents a major shift in planning philosophy. Before the rule changes, many advisors focused primarily on whether shares existed. After the rule changes, advisors must focus on whether the individual receiving the income satisfies the applicable requirements. At the bottom of the slide, the road illustration reinforces this concept. The old road represented automatic income splitting. That road is now closed. The new road requires a different approach. Review eligibility first. Only after reviewing the facts can a recommendation be made. This means advisors must spend more time understanding ownership structures, family involvement, business participation, and other relevant factors before recommending an income splitting strategy. The quote at the bottom captures the most important lesson from this entire section. The question is no longer, can we split income? The question is, do they qualify? That single question has become one of the most important considerations in modern private corporation tax planning. The key takeaway from this slide is simple. Income sprinkling is no longer a strategy that can be assumed. Every situation must be reviewed carefully. And before recommending income splitting, advisors must first determine whether the family members involved qualify under the applicable rules. That shift from assumption to qualification changed the game for corporate tax planning. To understand the significance of the new income sprinkling rules, it's helpful to compare the planning environment before and after the changes. This slide illustrates how dramatically the income splitting landscape changed for incorporated business owners. Let's begin on the left side of the slide. This represents the planning environment before the rule changes. A business owner could often distribute dividends to multiple family members who held shares in the corporation. A spouse might receive dividends. Adult children might receive dividends. Other family members might receive dividends as well. As income was spread across several individuals, the family could often take advantage of multiple lower tax brackets. The result was frequently a lower overall family tax bill. This strategy was widely used in private corporations. It was considered a common planning technique. Notice the benefits highlighted at the bottom of the left side. More flexibility, less review, fewer restrictions. The planning process was generally more straightforward. If family members owned shares, income splitting opportunities were often easier to implement. Now let's move to the center of the slide. This is where the rule change occurred. The government introduced new income sprinkling legislation designed to place restrictions on certain family income splitting arrangements. The objective was to ensure that tax benefits were not available automatically simply because shares existed. Instead, additional conditions and qualification requirements would need to be considered. This change created a new planning environment, and that new environment is illustrated on the right side of the slide. Notice what happens now. The dividend arrows no longer flow freely. Instead, each family member encounters a qualification checkpoint. Some individuals may qualify, others may require additional analysis, and some may not qualify at all. The outcome depends on the specific facts of each case. This represents the most important change introduced by the new rules. Income splitting became a qualification exercise rather than an ownership exercise. The qualification checkpoints listed on the right side illustrate the types of questions advisors now need to consider. Is the individual actively involved in the business? Do they satisfy ownership requirements? Are age-related rules relevant? Are reasonableness tests applicable? Do any exceptions apply? These questions became central to the planning process. And because the answers vary from one family to another, every situation must be evaluated individually. At the bottom of the slide, we see a direct comparison between the two environments. Before the changes, planning was generally more flexible and less restrictive. After the changes, planning requires more analysis, more qualification testing, more documentation, and a greater focus on compliance. This does not mean income splitting disappeared. It means the planning process became more sophisticated. Advisors can no longer assume that every family member qualifies. Instead, they must review the facts, understand the rules, and determine eligibility before making recommendations. The statement at the bottom summarizes the impact perfectly. Planning became more complex after the rule changes. That complexity is now part of the advisor's responsibility. Understanding ownership is no longer enough. Understanding eligibility is equally important. The key lesson from this slide is that the goal of income splitting may not have changed. Business owners still want tax-efficient family planning, but the process for achieving that goal has changed significantly. Today, successful planning requires analysis, documentation, and qualification reviews before income splitting strategies can be implemented. In other words, what was once relatively straightforward now requires careful professional evaluation. And that is why understanding these rules is so important for modern corporate tax planning. This final slide introduces the most important planning question that emerged after the income sprinkling rule changes. In the past, advisors often focused on one simple question: who should receive the income? Today, that question is no longer enough. The new question is, does the family member qualify to receive the income? This shift may seem subtle, but it fundamentally changed how income splitting strategies are analyzed. At the center of the slide, we see the starting point of the decision process. A family member is about to receive income from a corporation. Before any dividends are paid, before any strategy is implemented, a review must take place. The advisor must determine whether that individual qualifies under the applicable rules. This creates three possible outcomes. The first path is qualification. If the family member satisfies the relevant requirements, the planning strategy may proceed. The green pathway on the left illustrates this outcome. The advisor completes the review. The family member qualifies, and income can potentially be paid in a tax-efficient manner. This is the outcome planners hope to achieve. However, not every situation is straightforward. That leads to the second pathway in the center. Further review may be required. Some situations involve additional complexity. Perhaps more documentation is needed. Perhaps the facts are unclear. Perhaps exceptions or special rules need to be considered. In these situations, advisors must gather information, analyze the facts, review the legislation, and document their conclusions carefully. The key point is that assumptions are not enough. Professional analysis becomes essential. The third pathway is shown on the right side. The family member may not qualify. If that occurs, the planning strategy may need to be reconsidered. Income distributions that do not satisfy the applicable requirements can create adverse tax consequences. This is why eligibility reviews have become such an important part of modern corporate tax planning. On the left side of the slide, we see the qualification review checklist. This represents the core areas advisors typically examine during their analysis. First, involvement in the business. Is the family member actively participating in the corporation? Second, ownership interests. What shares do they own? What rights are attached to those shares? Third, age considerations. Certain rules and exceptions may depend on age. Fourth, supporting documentation. Can the facts be supported if questioned later? And finally, applicable exceptions. Some situations may qualify under specific exclusions or exceptions within the legislation. Together, these areas form the foundation of the advisor's review process. On the right side of the slide, we see the evolving role of the advisor. Before these rule changes, planning discussions often focused on distributing income efficiently. Today, advisors must also act as reviewers, investigators, and compliance professionals. They must understand the rules, review ownership structures, assess family involvement, identify risks, and document planning decisions carefully. This increased responsibility is one reason why professional tax planning has become more important than ever. Notice the statement at the bottom of the slide. Income splitting is no longer about who receives the income. It is about whether they qualify to receive it. This single sentence summarizes the entire shift created by the new rules. The focus has moved away from simple ownership and toward eligibility. The target graphic at the bottom represents the ultimate objective: compliant planning. The goal is not merely to reduce taxes. The goal is to reduce taxes while remaining compliant with the applicable legislation. When planning is based on proper analysis, proper documentation, and a thorough understanding of the rules, better outcomes can be achieved with greater confidence. The key lesson from this slide is simple. Every income splitting strategy now begins with an eligibility review. Before recommending that income be paid to a family member, advisors must first determine whether that individual qualifies under the rules. Because successful planning is no longer about finding a recipient. It is about confirming eligibility. And that distinction is one of the most important changes in modern corporate tax planning.